Welcome back to our Kofkin Bond monthly update. It's March already, which marks the beginning of autumn. While this is traditionally the season when things cool down, the economic and political scene is gearing up for a federal budget later this month and a federal election expected by May. The Dow recorded its second worst session for 2022 after Russia declared it would begin high precision attacks on Kiev. Overnight, Russia increased the shelling of Kharkiv, Ukraine's second largest city. The Russia-Ukraine situation is a key driver of markets at the moment, feeding into other problems. Oil prices spiked sharply overnight, with WTI up 8%, adding to more inflationary concerns globally, but also decreasing the likelihood that the Fed will do anything dramatic at the upcoming meeting. The yield on the US 10-year Treasury note continued to fall, down another 12 basis points overnight to 1.71%. It was only a matter of weeks ago that it was trading north of 2%. The fall saw financials down sharply in the US overnight. Higher rates and yields are better for bank financials. Russia's invasion increased volatility on global financial markets and uncertainty about the pace of global economic recovery. Notably, crude oil prices surged above US $100 a barrel, breaking the $100 mark for the first time since 2014. Rising oil prices add to inflationary pressures and could set back global economic recovery in the wake of COVID. In Australia, the price of unleaded petrol hit 179.1 cents a litre in February and is expected to go above $2. In the US, inflation hit a 40-year high of 7.5% in January. Australian inflation is a bit tamer at 3.5%, and this, along with unemployment at 13-year low of 4.2%, is raising expectations of interest rate hikes. The Reserve Bank stated earlier in February that a rate hike in 2022 is plausible. Personally, I think more likely, but that it is prepared to be patient. The Reserve is also looking for annual wage growth of 3% before it lifts rates, but with annual wages up just 2.3% in the December quarter, Australian workers are going backwards after inflation. The average wage is currently around $90,917 per year. Before the latest events in Ukraine, consumer and business confidence were improving. The ANZ Roy Morgan consumer rating rose slightly in February to 101.8 points, while the NAB Business Confidence Index was up 15.5 points in January, which was a positive 3.5 points. War in the Ukraine has triggered a flight to safety, with bonds, gold and the US dollar rising while global shares plunged initially before rebounding but remaining volatile. The Aussie dollar closed out at 72.5 cents. Australia's current account surplus decreased by $9.3 billion to $12.7 billion in the December quarter. The ABS said the decrease in surplus was driven by weaker exports of non-rural goods, while imports of immediate goods rose substantially. Home loan values in January actually rose 2.6% versus a consensus of 0.3% rise. Owner-occupier loans actually were up positive 1% and investor loans actually up 6.1%. CoreLogic Home Value Index rose 0.6 in February, up to be 20.6% for the year. Sydney house prices fell slightly at 0.1 in February. Sydney prices fell 0.1 in the month, Melbourne flat, Brisbane most improved, adding 1.8%. The latest news poll shows overall flow of preferences remains unchanged, with a two-party preferred split of 55% to 45% in Labor's favour. This represents a swing of 6.5% against the current federal government since the last election. RBA keeps rates on hold as expected. RBA notes the war in Ukraine is a major source of uncertainty. Observed inflation had spiked around the world and expectations of future policy interest rates have increased. Household and business balance sheets are in generally good shape here in Australia. Wages growth is still expected to be modest and is likely to be some time yet before in labour costs is a rate consistent with inflation being a sustainable target. Underlying inflation is expected to pop, then drop to 2.75% as the supply side problems are resolved and consumption patterns normalise. Expect sort of CPI inflation to jump on the back of higher fuel prices. will not increase the RBA will not increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. So basically what they're saying is be prepared to be patient. Thanks for tuning in, and see you all again next month.